All right, so what's the research question about, roughly speaking? So what I'm going to talk about today is what drives FDI in the form of foreign mergers and acquisitions. And the motivation for this is that, as I'm going to show you some stylized facts, the likelihood of FDI across industries varies quite a bit. And what I'm also going to show is that the ownership structure chosen by different acquirers also differs across industries. And what I'm going to try to answer is that why is this the case? And the main idea of the paper here is that the large part of the reason we're going to argue is the financial liquidity difference between acquiring and target firms. So what we do in this paper, just to give you a brief outline, is to build a very simple theoretical model which links firm-level liquidity to industry-level characteristics. And the reason we do that is that there's not much data available at the firm level for the countries we'll be interested in. And so we would somehow try to link this up to industry-level characteristics, which are relatively easily available. And the two characteristics we'll be focusing on are external finance dependence and asset tangibility, and I'll motivate these a bit more. And I'm going to present some evidence from emerging market economies. So I'm not going to go into too much detail into the existing work because we are so short on time. But basically, there's a literature out there which talks about the importance of liquidity during crises on mergers and acquisitions, and also in general how there is some across-industry allocation of liquidity in the US. But this is, I think, one of the first papers which talks about secular liquidity in emerging markets and how it affects mergers and acquisitions. So just to give you a brief preview of the theoretical results, what we'll find is that quite intuitively, foreign acquisitions are more likely in external finance-dependent sectors and sectors with fewer tangible assets. And we'll also find that larger foreign stakes, and I'm going to explain what that means, also more likely in these same sectors. And financial development can have a mitigating effect, and I'm also going to talk a little bit more afterwards about this. So just to give you some brief intuition about the theoretical results, since I'm not going to be able to go into the model into too much detail. So basically, we'll find that, as I said, foreign acquisitions are more likely in external finance-dependent sectors and sectors with fewer tangible assets. So what's the idea behind that? So what we'll find is that if you assume that domestic firms are liquidity constrained and foreign acquirers are not, then basically what happens is that more severe liquidity constraints would be there in external finance-dependent sectors and in sectors which have fewer tangible assets. And so basically what would happen is that financial liquid firms, they would be able to come in and buy these domestic firms which are liquidity constrained because they have a larger valuation of these liquidity constrained firms being not constrained themselves. And what I'll show you is that, or what I'll argue is that most of these acquiring firms are actually from developed markets, so they are relatively less subject to liquidity constraints, and that's kind of the idea. And what we'll also find in the theory, and I'm not going to go into that very much today, is that financial development can relax credit constraints of these domestic firms, and so therefore will lower the likelihood of foreign acquisitions. And what we'll also find is that larger foreign stakes, so basically foreign firms would end up buying more of a firm, more of a domestic firm in sectors which are external finance dependent and sectors with fewer tangible assets. And as far as we know, this is an interesting and novel result. And the idea behind, and the intuition behind it is basically this, that the way we're thinking about this process is that there are some local inputs which the domestic firm has a comparative advantage in providing and procurement. And so partial domestic ownership is basically a way for the foreign guy to come in and share some of these benefits of the input supplies from the local firm. But at the same time, giving some ownership to the domestic guy is a way to motivate him to be in the contract of supplying these inputs. And the basic idea here is that the outside option of domestic owners, so if they go on their own, they would just have to supply all the input themselves. And in those cases, they are more likely to be constrained in sectors which are external finance dependent or have less tangible assets. So basically, the idea is that the outside option of domestic owners would be lower when sectors are more external finance dependent. And that's going to drive the result that you can satisfy the participation constraint of these guys, these domestic guys, by giving them less of a stake when these sectors are more external finance dependent or have fewer tangible assets. So that's kind of the intuition. So I'll just give you a preview of the empirical results. What we'll find is that we'll find strong evidence for external finance dependence in the way that the theory suggests. We'll find mixed evidence for asset tangibility, and we'll also find that the effects are strongest for lower levels of financial development. So the outline of the remaining talk, I'll just give you two stylized facts which kind of motivates the model. And there are more stylized facts in the paper. You can have a look. And then I'm going to present just the outline of the model. I'll try to give the intuition with diagrams. And I'm going to present some evidence from these 15 emerging market economies over this period. So here what I'm trying to show you is that, okay, so we have all these acquisitions going on in these 15 emerging market economies, and they are being acquired by firms mostly from developed markets. I'm not showing you that, but what I'm showing you instead is that these target firms are in all these manufacturing industries. And what you can see is that on these columns is the how the percentage bought by foreign acquirers, or rather what percentage of the total acquisitions are by foreign firms. So as you can see, there's quite some variance across these different kinds of industries, and what we'll be trying to show is that this maybe has something to do with external finance dependence of these industries and asset tangibility of these industries. So basically you can see that there's the likelihood of a foreign acquisition varies quite a bit across these different manufacturing industries. And also this fact about how much ownership is acquired by the foreign firm, that, as you can see, that also displays some variance across these different kinds of target industries. And so one thing to remember is that our acquiring firms are from all possible industries, so including non-manufacturing industries, so for instance, financial firms, but we'll be looking only at these manufacturing targets. So the target firms are always in the manufacturing industries. So is this clear, kind of the motivation? Like, we're just trying to explain this kind of a variation in the percentage acquired by a foreign firm when it acquires a firm, and actually how likely it is that a foreign firm actually acquires the firm. All right, so basically the two main stylized facts, therefore, is this variation in the proportion of foreign acquirers across industries and the variation in ownership structure, what we're calling, across industries. And so we will basically be exploring a new explanation, which is the liquidity for these target firms, or in particular this industry variation in liquidity. And the other thing we will try to do is to compare it to existing theories of FDI and these MNC boundaries. That's kind of what we'll be also doing. So as I said, the main theoretical question is that is a target industry liquidity a determinant of FDI? And what the model will try to do is to generate hypotheses regarding the relationship between the likelihood of a foreign acquisition and external finance dependence and asset tangibility, and also the size of the stake and the same variables. So I'll just give you a brief outline of the model. So the main features of the model are that there are domestic firms, as I said, which are liquidity constrained. Foreign firms are not. Domestic firms have a comparative advantage in procuring a local input. And firms once acquired by foreign guys, they're more productive. Foreign firms face a fixed cost of acquiring, and industries differ in their external finance dependence and asset tangibility to the target industries. And I'm going to define these concepts precisely. So what do I mean by the tangibility of an asset and financial development? What do I mean by that in the model? So basically what we're saying is that the amount of debt, D, that a domestic firm can get is basically a percentage of tau JC of the total amount of investment that it's wanting to make. And this tau JC has two components. There's a country component, which depends on financial development. So if you're a more financially developed country, then you are more likely to get loans. So you are able to basically maybe pledge more of your assets and so on. And there's another component which is industry specific, and that's tau J. And so that is kind of, that sums up the tangibility of the assets. So if tau J is higher, the assets are more tangible. And so basically they can get more loans to finance these investments. All right, so that's tau J and tau C. These are going to be the key parameters, basically, which tell you what the tangibility of the assets are. And the formal definition of external finance dependence would be as follows. I'm not going to go into the formal definition. We basically define it in terms of stochastic dominance. I'm just going to show you a diagram. So basically, if you think about on the x-axis, the amount of liquidity that a domestic firm has, and 0 to 1 from the probability distribution, the cumulative probability distribution on the y-axis, this is basically gives you the cumulative distribution of liquidity in any particular industry. And what we're basically saying is that if a sector is less external finance dependent, then basically it has a liquidity distribution which is to the right. So it has basically more firms which have more available liquidity. All right, so external finance dependence is basically defined in terms of the liquidity distribution being to the right. Yeah, so there are more firms which are more liquid. And basically, therefore, they don't need so much external finance because they have this internal liquidity they can use. What about, how does this translate into foreign acquisitions? So what we show in the paper is that you can define these kind of neat zero surplus lines, as we call it, in the liquidity and productivity of the target firm in this plane. And basically, these show you the combinations of liquidity and productivity for which the surplus of an acquisition is basically zero. And I'm going to just focus on one diagram, and I'm trying to give you some intuition on it. So basically, as you can see, there are these two zones, which we'll be calling the domestic ownership zone and the zone of foreign acquisitions. And pretty intuitively, what we're trying to say here is that if you are a firm, domestic firm with low liquidity, then you'll be basically in that zone where you'll be acquired by foreigners. And if you're a guy with high liquidity, you can make these investments on your own, so you can remain under domestic ownership. All right, so that's kind of like the basic intuition here. And the reason this zero surplus line slopes upward is as follows, that if you have higher productivity, then you can kind of go on your own. So you basically have to be less liquid in order for the surplus to be zero. All right. So also intuitively, I'm not going into too much detail about the model, but what I show in the paper is that the zero surplus line for a more tangible sector will lie to the left, and that's also pretty intuitive. The idea is that foreign firms, if you're a domestic firm in a more tangible sector, foreign firms are basically less likely to be able to acquire you, and they will only be able to acquire you if you have lower liquidity. All right, so based on these, we can also have these zones of foreign acquisitions in a tangible industry and the zone of foreign acquisition in an intangible industry. And what you can see here is that in a tangible industry, basically there will be fewer of these domestic firms which are potential targets, just because they have more capability to get loans. And similarly, for a more intangible industry, the zone of foreign acquisitions is larger. Okay, so that's basically given by the zones of liquidity there. So as you can see, this will immediately lead to the result that if you think of a sector which is more external finance dependent, so if you think about the distribution of liquidity across firms, so this on the y-axis is the percentage of firms having a particular amount of liquidity. So as you can see, the left-hand, the blue line, is basically a situation where the industry is more external finance dependent. It has more firms which are in the less liquid area. And as you can see, if you are, the zone of foreign acquisition, therefore, would encompass a larger fraction of these firms. All right, so basically, you'll have more foreign acquisitions in external finance dependent sectors. And similarly, you can get the result that if you are, for any given distribution of liquidity, if you are in a more tangible industry, also there would be fewer foreign acquisitions. I'm not going to, again, go into the detail of the algebra of the ownership structure result, but again, just to emphasize the intuition for the result, that more foreign ownership happens in external finance dependence and intangible sectors. The basic idea is that I said that optimal ownership structure involves giving a higher ownership share to the domestic agent when her outside option is higher. And of course, the outside option of retaining ownership is higher when you are in a less finance dependent sector and in a more tangible sector. So we get the result that there's more foreign ownership in external finance dependent and intangible sectors. So, and also what you can show is that if you're above a certain level of financial development, then basically what happens is that this advantage that foreign acquirers have in external finance dependent sectors, that's kind of eroded. And this is basically shown here in the diagram. And so basically the distance A prime is the difference between an external finance dependent sector and a not so external finance dependent sector. And as you can see, when there's a greater amount of financial development, so if a country becomes more financially developed, you have fewer and fewer firms which are liquidity constraints. So basically the liquidity constraint above which you, or below which you will be acquired by a foreign firm, that goes down. And as you can see, if you are above a certain level of financial development, we show that in the paper, then you are actually more likely to move into a situation where the difference between external finance dependent sectors and a non-external finance dependent sector would shrink as there's more financial development, which is also pretty intuitive that basically what financial development is doing is kind of eroding the advantage that foreigners were having in that sector. All right, so what are the empirical hypotheses we form from the theory? Is that the probability of foreign acquisitions, as I said, is higher in external finance dependent sector. It's higher in intangible sectors. The size of foreign stakes would be higher in these external finance dependent sectors, and the size of foreign stakes would also be higher in the intangible sectors. And the part which I kind of like will probably not have time to go over today is this financial development results, which suggests that financial development reduces the likelihood of foreign acquisitions overall, and the effect is stronger in more external finance dependent sectors. So basically, if you are in a more external finance dependent sector and there's an improvement in financial development, you are more likely to benefit as a domestic firm. You'll be able to remain under domestic ownership, which might not be a benefit, as we know, because of technology transfer and so on, but you're more likely to be able to remain under domestic ownership. All right, so how do we test this theory? So we use a very simple linear probability model. We also do robustness tests with nonlinear models, and the result remains. So basically, you have a bunch of fixed effects, country, year, country pair, and so on. I'll give you some of those results there. We have basically external finance dependence, asset tangibility measures of these two things. The fraction acquired, so to control for the size of the acquisition. And as I shall show you later, we control for a bunch of other probable determinants of FDI. And we have also a bunch of macro controls. And to test whether the size of acquisition matters on the same factors, we have a similar regression. All right, so as I said, the baseline will be LPM, and all variables will be standardized. So I'll be presenting standardized coefficients, and the reason is that we want to be able to see whether alternative theories, how much they matter. And the results look very similar with logit and GLM. So a baseline regression is we are just putting in no macroeconomic control so far. And the first column is basically telling you what is the probability of an acquisition, of a foreign acquisition, and how does it vary with external finance dependence. As you can see, it goes in the direction predicted by the theory. So if you're more external finance dependent, you're more likely to be acquired by a foreign firm. And if you have more tangible assets, then you're less likely to be acquired by a foreign firm. And there are country cross-year fixed effects here. So we are controlling for all these time and country varying determinants here. So this is just our baseline kind of. The next column basically shows you the regression of the size of foreign acquisition on the same variables. And as you can see, external finance dependence is significantly positive, which is what the theory would predict. The sign of asset tangibility is correct one, but it's not significant. We do the same thing for the size of the foreign acquisition, but now we have country pair and year fixed effects to possibly control for bilateral factors. And the last column is also super interesting. It's basically saying we do the same test, so the fraction acquired by domestic acquirers in domestic acquisitions. And that, as you can see, is not sensitive to external finance dependence of the sector or the asset tangibility. So here we're kind of like the result we're trying to push here is that you have these foreign acquirers, and the basic idea is that these guys are not liquidity constrained. And what's driving the results is basically this difference of liquidity between foreign and domestic guys. And since the domestic guys are on average equally liquidity constrained, that's why we don't see the difference when this difference of ownership structure when we go and look at the domestic acquisitions. So now, I mean, you might say that, look, I mean, asset tangibility and these things are correlated with a bunch of things, right? I mean, so maybe, you know, the US firms are, developed market firms are doing information technology better, or they're, I mean, better at doing certain things. And maybe these are the intangible sectors. So maybe it's just that's what's going on. So, I mean, there's a bunch of other things which might be going on. And so these we call the trade-related controls. And so there's, for instance, the proximity concentration trade-off. And here, what we do is we control for the role of trade barriers, plant level returns to scale, and we also have industry level data on tariffs from the widths. There's also the cream skimming hypothesis, which basically says that, you know, these foreign firms come in and buy the firms which are most productive. So here what we're testing is that we have this measure of the technological efficiency of a particular industry from Levchenko and Zhang. And the basic idea is that if foreign firms target firms in more productive industries, maybe that's what's going on, and that's somehow related with asset tangibility or external finance dependence, and that's what we are picking up. Some of the other things we control for are this contracting approach to these MNC boundaries, and what Antras says in this 2003 QJE paper is that higher ownership and FDI is more likely in capital-intensive sectors. So we use the same controls as in Antras. And also, there are these theories of full ownership being more likely when industry uses foreign factors more intensively. And this is proxied by the capital-labor ratio. So alternative theories we partly control for. So there's, of course, this classic proximity concentration trade-off with firm heterogeneity, the Helpman, Melitz, and Yeapel model. So that suggests the firm distribution parameters as controls, but actually that speaks more to the distribution in the source country. And since we are primarily interested in the target country, we don't control for that. And also, there's this paper by Nock and Yeapel, and they say that you should control for R&D and advertising intensity, so we also throw that in. So what do we get with that? So the basic result is, as you can see, even with the controls, the external finance dependence measure, it gets less significant, but it's still positive and significant. And it is to be noted that these are standardized coefficients. So basically, you can kind of roughly compare the magnitudes of the coefficient and kind of get a sense of whether these things are important or not. And as you can see, I mean, compared to what we call the technological or other trade-related determinants of FDI, it seems this liquidity factor is also super important. And that's true in the first and second columns. The first column is just the same thing we did before, but now with macroeconomic controls. Also, it seems to be when you use these trade-related controls, the result is still there. And similarly, we have the result for the size of the foreign acquisition. When you control for all these factors, it's still true that external finance dependence matters. And that's where the liquidity comes in. And again, interestingly, what we find is that for domestic acquisitions, it doesn't really matter. The size of the domestic acquisitions the ownership structure, as we call it, doesn't seem to depend on the external finance dependence. That seems to be something exclusive to foreign acquisitions. So just to summarize my findings, so external finance dependence results are robust to controls. Asset tangibility has mostly the correct sign, but imprecisely estimated. Controls for alternative theories largely have the expected signs. I'm not going to go into that. And since there's a standardized coefficients, the magnitude suggests that the liquidity channel is large and comparable to other channels. So basically, the probability of foreign acquisitions higher in external finance dependent sectors, probability of foreign acquisitions higher in intangible sectors, and the results that the model would predict, they kind of go through. And as I said, the effects are absent for ownership structures in domestic acquisitions. And it's robust to the exclusion of financial sector FDI and such like. So I'm not going to go into the results on financial development today because I'm going to run out of time. But basically, what I would like to conclude is that, this paper, I think, presents a new channel, which is this relative liquidity of foreign acquirers versus domestic acquirers, and also domestic versus domestic acquirers and domestic targets as a driver of acquisitions, and specifically here FDI. And also what's interesting as like the boundaries of the multinational corporation, in the sense that whether you acquire full ownership or whether you acquire partial ownership and so on. Something which I didn't show you, of course, is that the channel is likely to be more important for countries at the lower end of financial development. We can talk about that later on. And ownership structure is actually driven by liquidity even for more financially developed markets. So the results on ownership structure seem to be more robust to the inclusion of these financial development measures. So that's about it.
What I'd like to do is to draw your attention to a couple of papers to motivate my discussion. The first is a paper that was sort of an exploratory data sort of exercise where we looked at foreign acquisitions of emerging market targets and mainly focused on developed market acquisitions of emerging market targets. And that was sort of the NBER working paper that came out in 2004 and then subsequently was published in the RFS, and where we look at more directly, so Rahul showed us this zero surplus line, and then the question becomes, when is surplus created in these acquisitions by developed markets of emerging market targets? And so we sort of try to estimate this more directly, and I'd like to sort of take you through it just to sort of situate this paper that Rahul just presented. So in these papers, what we do is we look at foreign acquisitions of publicly traded emerging market firms, because what we argue is that they offer a unique opportunity to estimate the market capitalized returns or the surplus value creation via FDI flows from developed to emerging markets. So some stylized facts and questions that come up in this context is that what we see in this 20-year period that we looked at, and Rahul's paper looks at it till 2007, developed market acquirers experience positive and significant returns when emerging market acquisitions are announced. So what this suggests is that positive surplus value creation is anticipated when developed market acquirers announce an acquisition of an emerging market target. A side sort of result is that the emerging market target stock return also goes up, which suggests that surplus value creation is anticipated there as well. But what was surprising, and Rahul didn't get a chance much to talk about the ownership structure, what we found is that these returns triple. So there's a huge jump when a majority control of the emerging market target is acquired. And so that sort of led us to sort of ask the following question, that why are positive developed market acquirer returns related to acquiring control? Why is control of the emerging market target so important in these transactions? And what are the factors, what are the underlying factors that drive the importance of control when we look at these dollar value gains, which are in the billions of dollars when you actually do the calculations for acquiring firm shareholders? And to do that, we sort of appeal to very standard property rights theory of the firm and acquisition of control, where basically the argument that's made in a sort of traditional Grossman, Hart and Moore, etc., all these papers that are very well known, seminal papers, that control can resolve problems associated with incomplete contracting. And the second sort of feature of these models, such as Holmstrom and Tirole 1991, is that acquirers are more likely to share proprietary technologies and intangible assets. So when we're talking about the less tangible asset acquisitions, that acquirers are more likely to share proprietary technologies and intangible assets, especially in settings where you have non-verifiable monitoring and weak contracting environments. So both of these features, sort of in our opinion, fit emerging markets very well. When you have an emerging market target, non-verifiable monitoring, and you're working with a weak contracting environment. So we thought that these are sort of, since this is a setting which is ripe for looking at this issue of the acquisition of control, what we hypothesized is that the acquisition of majority control will be associated with surplus value creation, which is the positive market capitalized returns in developed market acquisitions of emerging market targets. And to motivate, let me just sort of give you a slightly different theoretical formulation. And it's a very simple one, which allows us to sort of make our points, which is that we assume that if an announcement is made and the acquisition takes place immediately, so you can appeal to standard asset pricing theory, which basically tells us that the market valuation of any firm's project is just given as the expected present discounted value of its expected future cash flows. So you're just looking at the stock price as the expectation of the discount rate times the infinite stream of the cash flows. Now, what we try to do within this is to build in two features. One is the incomplete property rights and seeing it as a tax. So we define gamma as an index of institutions conditional on development, where gamma ranges from 0 to 1, and the higher the gamma, the weaker the set of institutions. And then you can just look at this binary sort of division theoretically between emerging markets, which have a higher gamma, or weaker institutions, and developed markets which have a lower gamma and stronger institutions. The second thing that we hypothesized is that the technology is an intangible asset. and we assume a payoff side to the technology and assume that this is decreasing in gamma. So if you're in a weaker contracting environment, the possibility to extract surplus value is going to be declining. So the breadth of the property rights protection, the lower is gamma and the higher the payoff to the firm from the technology. So if an acquiring firm is going to actually acquire, control, and then operate its technology, the surplus value creation is likely to be higher. So then what we did was we basically looked at the present discounted value of the target in terms of their operating with their, if you look at this, this would be the discount factor or the higher cost of capital in an emerging market. And then these are the cash flows, and this is basically the tax of operating in a weaker property rights environment. And if capital markets are segmented, then the cost of capital at which the developed market acquirer can raise capital is going to be lower than that of the target, and this 1 plus CC is basically this wedge between the cost of capital for the acquirer versus the target, and this sort of signals the fact that, you know, developed market acquirers have much deeper pockets than emerging market targets in more capital scarce countries. So if a developed market firm acquires control, it can implement its technology and operate it within its own management, then the value of the target is different, because now they can raise capital at their own cost of capital. These are the cash flows. They're bonded through control to a better property rights environment, and also so the surplus value creation from operating the tangible technology is going to be higher, and then the sort of the weaker property rights tax is going to be lower. So what this suggests is this value of the target goes up under the operation of the developed market acquirer. And if the acquirer bids this amount, which is obviously going to be less than the amount that it's going to extract once the target is under its operation, the return to the acquirer is simply the difference between the price, the value of the target under its operation versus the amount that it bids. And we have this theta coefficient, which tells us something about the bargaining power of the target in order to extract this surplus from the acquirer. Bottom line is the acquired return will be larger, and this is very similar to some of the things that Rahul was talking about, which is the larger the value of the technology transfer, so the more intangible the assets, the larger the gap in institutions between two countries. So, you know, if you have emerging markets with weaker rules of law, higher risks of expropriation, etc., the greater the complementarity between technology and institutional protection. So think about this as an interaction term between asset intangibility and the institutional framework. The weaker the bargaining power of the target, and finally, the larger the liquidity effect as reflected in discount factors. Okay, so here majority control is a key threshold, and empirically the payoff to an asset can differ across country given differences in the know-how, brand value, and other intangibles, which, as Rahul also said, is an industry effect. So we said that in that paper, and the institutional setting that protects property rights. So we also sort of captured this country effect in these papers. So when are the acquire returns? So our dependent variable was acquire returns. When are they the largest in this paper? When control is acquired and you have large intangibles. When control is acquired and in countries with high risks of expropriation, contract repudiation, and weak rules of law. When control is acquired and there's a complementarity between asset tangibility and institutions. And when control is acquired and there is an increase in the cost of capital in an emerging market. Okay, so those are our main findings. What are the main findings of the paper that Rahul presented? So now our dependent variable is probability of acquisition, right? And when is the probability of acquisition the highest? Probability of the acquisition the highest in external finance dependent sectors, which you're calling that liquidity effect. I'll talk about liquidity versus external finance dependence in a sec. Probability of foreign acquisitions is higher in intangible sectors. Size of foreign stakes, so this is the control variable, is higher in external finance-dependent sectors, and the size of foreign stakes is higher in intangible sectors, right? And then they don't find this effect for domestic transactions. So my main sort of question when I read this paper was, what is the incremental contribution of this paper relative to previous work? And I mean this as a very serious question. How are you going to distinguish yourself from already sort of published work, which is sort of coming at it from a different angle? So I think it would be useful for you to do that. At a minimum, it would be useful for you to acknowledge this previous published work. And also to sort of, you know, what does the stylized model, you know, you went through these bells and whistles and the zero surplus line and all these zones, et cetera, but you're not able to actually test for firm level liquidity, right? There is no firm level liquidity measure in your regressions. It's basically an industry effect, and then you're sort of looking at these probabilities of acquisition in an industry. So what does the stylized model really act? And what I showed you was a very simple couple of pages. The exposition is done, and you can get your intuition across. So what does the stylized model add to the benefits, to the theoretical industrial organizational literature on boundaries of the firm? And what are precisely the new facts that we learned from this exercise? And you know, this is something that I want to put out there, which is, are we just replacing stock returns on the left-hand side with probability of acquisition on the left-hand side? So that's sort of one question for you. And the other things that I sort of feel like liquidity is a misnomer. External finance dependence is basically when you are dependent on external sources of finance to finance your investment relative to internal sources. Liquidity in finance is a very sort of short-run phenomena, which is related to your ability to pay off current liabilities with your current assets. Okay, so external finance dependence is not liquidity. So I don't think you should be calling this paper liquidity-driven FDI. If anything, it should be external finance dependent FDI. Measures of liquidity are related, you know, it's things like cash ratio, quick ratio. Is this firm going to, you know, is it going to be able to meet its short-term liquidity needs? That is what, you know, we really need to be focusing on. And you know, this definitional difference, I think is important.